Calumet reported Q2 2026 earnings on August 7th and completely missed consensus on the bottom line, but honestly just blew past top-line estimates. I mean, EPS came in at negative $1.09, which misses the consensus estimate of a positive 7 cents by a massive $1.16. But then revenue beat expectations handily at $1.445 billion, which is, a $330 million beat over the $1.11 billion consensus. That's up 40.8% year over year.
Right. And looking ahead, management is actually guiding for a stronger Q3. They have no planned turnarounds on the schedule, and they're targeting a restricted group leverage ratio dropping below 3 times. Plus, they expect a steady state ramping of their Montana renewables facility over the back half of the year.
Yeah, and shares took an immediate pre-market hit of around 5.5% on that gap miss. The stock opened at 43.75, saw a brief midday recovery as the market kind of, digested the revenue beat, and ultimately closed down about 4.5%, right around the $40 mark.
So it's definitely a volatile day for anyone holding the stock.
Oh, absolutely. So your mission for today's deep dive is to really unpack all this. We are going to tear apart these sources to figure out if you should trust the brutal GAAP reality of a company seemingly swimming in regulatory debt, or the underlying cash flow of a business that is quietly printing money in its core operations.
Because looking at Calumet's GAAP EPS right now is really like looking at a distorted funhouse mirror.
Exactly. It's reflecting the regulatory environment, not the actual cash generation of the physical business you own shares in. The headline, EPS miss, was driven primarily by a massive $163.6 million non-cash RINs expense.
Right. Those are renewable identification numbers.
Yeah. And here's where I have to pause and try to figure this out with you. Because, if this RINs expense is strictly a non-cash accounting metric for the quarter, why did algorithmic and institutional traders immediately panic and drop the stock 5% pre-market?
It's a really fair question.
Isn't Wall Street smart enough at this point to look past a gap and just focus on the adjusted EBITDA for a refiner?
Well, you would certainly think so, yeah. Especially when you look at the core physical operations, which are actually highly profitable right now. Adjusted EBITDA was $159.3 million.
Which is huge.
Right, that is up 189% year over year from $55.1 million.
Yeah.
And if you factor in the tax attributes, adjusted EBITDA hit $175.2 million. So those are incredible growth numbers.
Yeah, they really are.
But, we have to validate the market's fear here. Because that RINs liability is not just some phantom accounting entry that vanishes at the end of the year. It is a very real, very threatening balance sheet burden.
It's an actual liability hanging over them.
Exactly. We really need to explain the mechanism here so you understand why Wall Street hit the sell button. As a merchant refiner, Calumet is mandated by the EPA to blend a certain volume of renewable fuels into their petroleum products.
Okay.
If they don't have the physical infrastructure to blend enough renewables themselves, they are basically forced by law to buy these invisible credits, the RINs, on the open market from companies that do.
So it essentially weaponizes a government policy into a financial liability for traditional refiners.
Yes, exactly that.
You have to go into the open market and pay whatever the going rate is for these credits just to stay in compliance, and those prices can be incredibly volatile.
They can be wildly volatile.
Yeah.
And the issue for Calumet is the sheer scale of how fast this liability is growing. Their current RIN obligations sit at a staggering $480.2 million.
Wow.
Just to put that into perspective for you, that is up from $169.3 million at the end of 2025.
Wait, it went from $169 million to over $480 million in just a few months.
Yeah, it nearly tripled.
Yeah.
So when institutional investors have strict risk parameters programmed into their trading models, a liability that triples that fast and approaches $500 million triggers every single alarm.
Oh, for sure.
It transitions in their eyes from a manageable operational cost to a structural balance sheet risk.
That makes total sense when you frame it that way. It's kind of like owning a restaurant that is packed every single night. You are turning tables, generating tons of cash at the register, but there's a giant growing tax land sitting on the back office desk that you eventually have to settle.
That's a perfect analogy, yeah.
The risk models see a $480 million regulatory liability, and they just dump the stock, regardless of how many meals you are serving out front. But look, If you are holding the stock, you have to look past the algorithms and understand where the cash is actually coming from to pay that liability.
Right, because the underlying business is moving.
Exactly. The core operations are clearly generating cash, but to see exactly how, we have to look under the hood at the specific segment performance. And honestly, looking through these segment notes, it really feels like a violent tug of war between pricing power and input costs.
It absolutely is a tug of war.
Yeah.
And the best way to understand the underlying health of Calumet is to walk through their three main segments pretty tightly, because they are each experiencing completely different macroeconomic realities right now.
Yeah, the contrast is crazy.
It really is. So let's start with the pain point, which is performance brands.
Right. Performance brands is their consumer-facing side. And here's where I have to push back a bit on the narrative that input costs are just crushing everyone equally. They literally just announced record quarterly sales of True Fuel.
Yep, they did.
I mean, if you go to a hardware store, that stuff is everywhere. So if you are holding this stock, you're probably looking at that record True Fuel volume and screaming, how did our profits get cut in half?
It looks so bad on paper.
Their EBITDA dropped from $13.5 million last year down to $6.3 million this quarter. If you are moving record volume off the shelves, how do your margins implode that badly?
I know. It's incredibly frustrating for investors to see record sales volume paired with plunging profits. But it all comes down to a timing issue rooted in accounting mechanics, specifically LIFO.
Last in, first out.
Exactly, last in, first out accounting. Input costs, which are the base crude and raw materials they need to manufacture products like True Fuel, spiked significantly and rapidly over the quarter. But they spiked much faster than Calumet could realistically raise their retail prices to the end consumer. That lag resulted in a $7.3 million LIFO inventory headwind.
Okay, let's unpack that LIFO trap for a second so we understand exactly how this punishes the income statement. Under last in, first out, when commodity prices jump, the newest, most expensive inventory you just bought is the first inventory that gets recorded on your income statement as the cost of goods sold. Am I reading that right?
You are reading it exactly right.
So you are effectively penalizing yourself on paper.
Yes. Let's say you got raw materials 3 months ago at $50 a barrel, but last week you bought them at $80 a barrel. Under LIFO, when you sell a can of True Fuel today, the accounting rules require you to record that $80 barrel as your cost.
Even if you are physically using the older, cheaper inventory.
Right, even then.
Right.
So your accounting costs reflect the absolute peak of the commodity cycle, while your retail prices on the shelf at the hardware store haven't caught up to that $80 reality yet.
Man, so even if you are selling a record amount of True Fuel, the price lag at the retail level just compresses the margin completely. The consumer is still paying the old price, but your income statement is eating the new higher cost.
It is a brutal squeeze.
But it's also temporary, right? I mean, once retail prices catch up or if commodity prices fall, that LIFO headwind reverses.
Precisely. It is a temporary timing mismatch, not some permanent destruction of the business model. But, while performance brands took that temporary hit, you look over at the Specialty Products and Solutions segment, SPS, and they were just the absolute hero of the entire quarter.
Oh, yeah, those numbers were wild.
They generated an adjusted EBITDA of $161.7 million, which more than doubled from $66.8 million in the same quarter last year.
That is a staggering jump. I mean, going from $66 million to over $160 million in a single segment in 1 year, I have to assume that's not just them running the plants a little harder, right?
No, definitely not.
Is that a function of the structural global supply crunch we've been seeing, or did they just suddenly find massive pricing leverage?
It's really a combination of both, and it highlights why physical assets are so incredibly valuable in a constrained market. They benefited from a severe global shortage and structurally tight supply in the specialty base oil markets.
Okay, what kind of oils are we talking about here?
We are talking about the highly refined lubricants, waxes, and specialized solvents that industries absolutely need to function. Right now, supply chain disruptions has caused a global shortage without a clear near-term solution.
Right.
And when you combine that with the fact that refinery industry utilization is at record highs globally and inventory levels are just bone dry, pricing power swings entirely to the producer.
So if you have the physical capacity to actually produce these specialty base oils right now, you can basically dictate your price to the market because buyers just have nowhere else to go.
Exactly. And Calumet leveraged this dynamic perfectly. They drove record production of nearly 63,000 barrels per day in this segment. And because they possessed that ultimate pricing power, their adjusted EBITDA margins didn't just grow, they expanded massively, jumping from 10.6% last year to a whopping 16.0% this quarter.
That's huge for a refiner.
Yeah, in refining, a 16% margin on specialty products at that volume is essentially a license to print cash.
That is the exact opposite of the performance brand situation. I mean, in the consumer segment, they were getting squeezed by the lag. But in SPS, they were selling business to business in a supply crunch, so they had the pricing power to far outpace their input costs.
Perfectly said.
You have one segment getting choked and another segment printing money.
Yeah.
Which leaves the third pillar, right? Montana Renewables. How does their sustainable aviation fuel facility fit into this dynamic?
So Montana Renewables, or MER, reported adjusted EBITDA with tax attributes of $26.6 million for the quarter. That is a solid bump from $16.3 million last year.
Okay, nice growth.
But what makes this highly impressive, and what you really need to understand if you were evaluating their growth potential, is that the facility was actually offline for a significant chunk of the quarter.
Wait, they were offline?
Yep.
Because I'm looking at the production numbers here, and they produced only 7,011 barrels per day in Q2. That is down significantly from the 12,044 barrels per day they produced in the same quarter last year.
Right, a big drop.
So they produced roughly half the physical volume year over year, but their EBITDA still went up by $10 million. How does the math on that even work?
It works because of the incredible margin profile of what they are actually producing. They took the plant offline for a planned turnaround and expansion in April and May, but upon restarting in early May, they captured incredibly robust renewable margins. So even with the lower overall volume due to the downtime, the profitability of every single barrel they did produce in the back half of the quarter was just significantly higher.
Okay, so the planned maintenance, the turnaround, actually masks how profitable that facility is operating right now. For the half of the quarter they were actually running, the margins were so fat they made more money than they did running full out last year.
Exactly. It's wild.
That is wild. So with Montana Renewables coming back fully online for Q3 without any planned turnarounds, and the specialty product segment just printing cash, management basically has a massive windfall of capital.
Which means they finally have a clear runway to address their biggest existential threat.
Right, that highly leveraged balance sheet we talked about at the top of the show.
This is where the story gets really critical for investors. What does management do with the cash?
Yeah, because looking at this balance sheet, Calumet's current strategy feels like a high-speed race between their physical refinery acceleration and that ticking regulatory debt bomb from the RINs.
It's a race against the clock.
CEO Todd Borgman stated on the call that they expect the restricted group leverage to drop below 3 times next quarter. But look, I have to challenge this, because if you are a retail investor looking at the actual filings, they have total liabilities of $3.68 billion against just $2.8 billion in assets.
Yeah, it's no pretty.
They have negative stockholders' equity of $1.1 billion.
Okay.
Is a sub 3 times leverage ratio actually realistic for you to bank on without management doing some massive dilutive equity raise that just wipes out current shareholders?
It's a very fair challenge, and it's exactly what the bears on this stock point to every time. Looking at a balance sheet that is technically underwater in terms of equity is terrifying.
Right.
But you have to look at the immediate aggressive cash actions management is actually taking right now to make that sub 3 times target a reality without diluting shareholders. They are aggressively using that specialty segment cash windfall to extinguish debt.
Okay, so what did they actually do?
Well, in July alone, they retired $115 million in debt.
Wow, okay. How did they deploy that exactly?
They redeemed $100 million of their 9.75% 2028 notes at a premium, and they completely repaid a $15.5 million Montana terminal asset financing arrangement, which was, essentially a high-interest sale-leaseback of their truck rack.
Retiring 9.75% notes is a huge deal for free cash flow. Every single dollar of that principal they pay down is effectively a guaranteed, risk-free, near 10% return in annual interest savings.
Exactly. It's a massive win.
It instantly improves their cash flow profile going forward. But to pay down $115 million in a single month, they have to be pulling cash from somewhere else in the business. I mean, they can't fund that from standard operations without making some sacrifices somewhere.
And this is the sacrifice. They are deploying zero growth CapEx for the rest of 2026 for the legacy business.
Oh, wow.
Zero. They have essentially locked the company credit cards in a safe and thrown away the key. They froze capital expenditures across the board to focus purely on debt paydown and cash harvesting from that highly profitable specialty segment.
That's a bold move.
The only growth vector they are actively leaning into right now is Montana renewables, because it is largely self-funded at this stage and holds the key to their long-term valuation.
Okay, well, let's dive deep into that growth vector because the Max F-150 expansion in Montana seems to be the linchpin of their entire multi-year thesis. If they are freezing capex everywhere else, this SAF project absolutely has to work.
It does, and so far they are hitting their milestones. They just completed Phase 1 of the Max F-150 expansion.
Great.
Management is now targeting a sustainable aviation fuel, or SAF-F, run rate of 80 to 100 million gallons by the end of this year. By spring 2027, they expect to push that run rate to 120 to 150 million gallons.
Look, it's scaling up fast.
Yeah, and the ultimate target they've laid out is scaling to 200 million gallons of SAF production by 2028.
And there is a mechanism behind that 2028 target that is crucial for you to understand if you are evaluating their capital risk. Management noted this 200 million gallon target will be achieved via a lower cost, capital efficient reactor reconfiguration rather than an expensive greenfield build.
Yes, that distinction is everything.
I think a lot of people glaze over terms like reactor reconfiguration. But if you follow the renewable refining space, you know that greenfield builds, which means buying new land, securing new permits, pouring new concrete, and building a facility from the ground up are notorious for massive cost overruns and multi-year delays.
They are a nightmare.
By doing this through a reconfiguration of an existing hydrocracker at an existing site, it completely changes the return on invested capital profile.
Exactly. It drastically reduces the capital risk profile. By modifying existing infrastructure, they avoid the billions in upfront costs that absolutely plague their competitors.
Right.
It is a highly efficient deployment of capital that allows them to use the cash generated from the specialty segment to aggressively pay down high-yield debt, while the renewable segment scales its capacity organically.
So it's very intentional.
It is a very deliberate two-pronged strategy. Starve the legacy business of growth capital to fix the balance sheet while self-funding the high-margin fuel of the future.
So when you synthesize all of these moving parts, the LIFO headwinds, the specialty base oil cash windfall, the capex freeze, and the SAF expansion, Calumet's future valuation hinges entirely on a binary race.
It really does.
Can their exceptionally strong physical downstream operations generate enough cash to organically retire their debt before that rapidly accumulating $480 million RIN liability forces a painful regulatory settlement? It is a high-stakes collision between brilliant physical market execution and the crushing weight of Washington's renewable mandates.
That is the defining tension for the stock right there. If the physical cash flow from specialties and the new Montana renewables expansion outpaces the regulatory burden, the equity re-rates significantly higher because the leverage drops.
Makes sense.
But if the RIN liability continues to compound faster than they can retire the debt, the balance sheet stress will cap any upside for the stock, regardless of how much true fuel they sell.
Which leaves you with one final variable we haven't even touched on yet, which is Washington, D.C. If the EPA decides to tweak the renewable volume obligations next year, if they adjust the mandates based on political pressure or lobbying from traditional refiners, that $480 million liability sitting on Calumet's balance sheet could be wiped out, or it could be doubled with a single stroke of a pen. So you have to ask yourself, are you investing in a refinery's operational excellence, or are you ultimately just betting on a political outcome in an election cycle? It's a fascinating risk-reward setup. Follow the show for daily earnings coverage.